Welcome. This is Achievers College of Professional Zembu, the class of Financial Management. And in today's topic, we will be covering capital structure and the cost of capital. I know that when we talk about every organization requires some capital so that it can be able to operationalize, or it can be able to make its things running. And when we talk about, so in today's topic, it is about capital structure, and its cost of capital. When we talk about capital structure, the capital structure we have seen that every organization requires some funds, and these funds that the organization requires, it is for it to be able to finance its world, to finance its operations. What we use those funds that are required to finance the operations is what we are referring to as capital. And the capital structure mainly means the way the organization arranges or how it is able to finance its assets, either through a combination of equity or combination of debt or a hybrid of securities. And the capital structure of the company consists various things. There are 5 things that the capital structure comprises. One, we talk about equity shares or equity, which normally people they call shares. That is number 1. Number 2, we talk about preference shares. We will be able to differentiate between preference shares and equity shares. Number 3 is bonds. Number 4 is bank loan. And number 5, it is debentures. So we are saying capital structure of a company will comprise equity shares, preference shares, bonds, bank loan, and debentures. We'll be able to tackle each of these separately. And when we are referring to as equity shares, what is equity shares? Equity shares, we say that it is the ownership. Mostly it becomes the ownership of the company. Most of you know that when we talk about a person has bought shares of a given company, it means that he has got some ownership of that particular company. That is what we call the shares. So when we are talking about equity shares, we are referring that that person has become an owner of that particular company. For example, if maybe a company has floated maybe 1,000 shares, that is what the company has floated, and maybe a person purchases 51% of the 1,000, that means he has 500 plus shares. That means that he becomes now the person who has the majority shareholding. So it is like he becomes the person, like the owner of that particular company. Then we have the preference shares. The preference shares, you see that they are just like equity shares, but these ones, they have a difference. The only difference that they have is that the preference shares, these ones, they receive dividends at the end of every trading period. They receive dividends. And also, these ones, they receive dividends at the end of every trading period. But now the difference between the preference shares and the equity shares is that the preference shares, they receive dividends before the ordinary shares or the equity shares, meaning that, and they have a specific percentage of dividends that they receive. So after every trading, you realize that these people, or the preference share owners, they are entitled. Let's say it is a 5% dividend, 5% percentage of dividends that they receive on every profit. It means that before the equity shareholders are given their dividends, the preference shareholders are given first. So it means out of the profit that they receive, before they get What remains is what the equity shareholders will get after. And even these ones, they are paid even before the debtors. Even before you pay some debt, the preference shareholders are given their dividends. That's why preference is from the word preference. So they are given first priority. That is the equity shareholders. The difference between these is that when it comes to the claims in this preference shareholders, maybe in the case of winding up a company, the preference shareholders, they are given the first priority to claim the assets of that particular company before the equity shareholders. Number two is say that dividends I've talked about, they are also given dividends before. And number three difference is that when it comes to the redemption of shares, maybe a person requires now to redeem preference shares, it means that there is what we call redeemable and irredeemable preference shares. Meaning that these ones, unlike the equity shareholders, whatever remains is what they are going to get. But for the preference shareholders, it means that their shares can be issued before the equity shareholders. And the other thing is that the other difference is that the preference shareholders can be able to convert their shares easily than the equity shareholders. So that's the difference between equity shareholders and the preference shareholders. But all of them, we say that they are owners of the company. They are owners of the company. So that is the first, the two types of capital structure. The other one is about the bonds. And the bond, we say that it is an instrument. An instrument that is issued for more than 1 year. Instrument that will be issued for the more than 1 year for the purpose of raising capital, or what we are calling the funds. Remember, we saying that every business will require some funds, and the funds is what we refer to as capital. So those funds, we say that the bonds now, they are instruments. And these instruments, it's the company that issues to people outside. And those who have some money, they are given some bonds for them to be able to purchase those bonds, and then that one will be for the purpose of raising some funds to run the organization or be able to run the operations of the company. The other type of capital is the bank loan. Bank loan, everyone knows about bank loan. That is where you go to a bank and then you source for capital. Either you have assets, you get the secured loan or unsecured loan. That one will depend on the arrangements that you will get with your bank. Then the other one is the debentures. When it comes to the debentures, we say that it is unsecured. This one becomes an unsecured debt. This one is unsecured debt. And this unsecured debt, it will be backed. What we say is that being unsecured debt, it is backed by the integrity of the borrower. The integrity of the borrower. Integrity of the borrower. And this one entirely, it does not depend on any collateral, or it is not going to be documented by any agreement. So when a company says that it has raised some debentures, so it is every person now will come and get this, and it is kind of an unsecured bond. That is why we are saying it is unsecured bond. So those are the various ways in which an organization can be able to raise capital or to raise some funds for it to be able to finance its operation. Now, when we have looked at that, then the whole, what we are calling now the capital structure, it is the combination of all these. An organization may decide to use 1, 2, or 3 of all these types of funds for it to be able to finance its operation. And that is what we are referring to as the capital structure of the company. Now, let us look at the cost of capital. And this cost of capital, what are we talking about? Cost of capital. The cost of capital now comes in cost of capital. This cost of capital, we are saying that it is how the organization will determine how it is going to finance its operation, or it's how it's going to fund its operations. And when we are saying that when it comes to the cost of capital, we say that it can decide whether it is going to raise its funds through debt or it is going to raise its funds through shares. So it is either debt or shares, because remember what we are saying. We have seen that in the various types of funds, we have the shares, and all the others, the debentures and the bonds, they are debts. So it means that the financing is either through debt or equity. You are financing through debt or equity. So the cost of capital includes the cost of debt, because when you are raising these debts, there is some cost that is going to be involved in the acquisition of that fund, acquisition of the capital or the fund that we are talking about. Cost involved. And then if it is the shares, there will be the cost of, maybe if there will be cost of dividends, there is cost of issuance and everything and all the logistics. If it is debt, there will be the cost of debt, which is the cost of debt. The cost of debt we are talking about, there is interest involved and so forth, the collaterals and everything. If it is the debentures you are floating, there has to be the cost that is going to be involved. So that is what we are referring to as the cost of capital. And when maybe a finance manager or the owners of the company decide on which form of capital to use, then it means that they have to calculate what cost will be involved, what cost will be moderated, so that they can be able now to come up with an effective one. So we will start now with the first one, which we say that is the cost of equity. Remember, equity, we have said we have two types of equity. We have the cost of we have the preference shares, and then we have the ordinary shares. All those now is the cost of equity. How are we going to look at this cost of equity? In the cost of equity, we are saying that the firm is able to represent the compensation that the market demands in exchange for the owning up of the assets and every bearing of the risk of the ownership. Because now when a person purchases the shares, it means that he has forfeited his amount of money. He has taken a risk investing in that. So the company must be able to know how is it going to bear that cost of that particular person or the investor who has given his money. He could have used his money in other areas. So that is what we are referring to as the cost of equity. And this cost of equity is determined using two methods. We have two methods that are used. Number one method, we are saying that we use the dividend growth model. Dividend growth model. One, because we are saying every shareholder of a particular company requires, at the end of every trading period, from the profits that have been got from that operation of the company, he has to get some dividends. That is why he has invested in that area. So we are going to determine the cost through the dividends that the company now is going to pay. Remember, we are talking about the cost. It's the cost that the company will incur so that it can bear it can be able to bear the ownership, the risk of ownership. And the number two way of determining the cost of equity is what we call the capital asset pricing model. The capital asset pricing model. Mostly people call it CAPM. The capital asset pricing model. We will look at these two ways in which we are going to determine the cost of bearing the risk of ownership of the company, which we are calling now it is the equity. Remember, equity, we say it is the shares of that particular company. Now, let us start by looking at now the dividend growth model. The dividend growth model. this dividend growth model, we have this model whereby we are saying that under this model, the cost of equity, it is the returns, or what we are calling the dividends. And the dividends that their shareholders are going to expect after a certain trading period. And now we have this formula that we are going to use. The formula is KE. K represents the cost of equity, or the cost of shareholding, which is equals to, into bracket, we have the dividend, which you see, it is the current dividend, current dividend, 1 plus the growth. We are going to look at how we are going to determine the growth. Then all these we divide by the price, the market price of the share, close the bracket, then plus the growth. Where here we are saying that KE is the cost of equity, is the cost of equity. DO, we have said it is the dividend, is the dividend, or which is current, the current dividend. Let's look at the current dividend. That is the current dividend. Then we have G. G is the growth, or what we are saying, it is the growth rate, or the expected growth rate of the growth of the dividend. And then we have our P. PO is the market price of the share. Is the market price of the share. When we say that the cost of equity is KE, all this we are saying that the cost of equity will be. What we are looking at is the dividend, the current dividend that we are using. For example, if we are saying that Safaricom has given you a dividend of 3 bob, so that is the current dividend. Then there is 1, which is a constant. This is a proven formula. And then we have the growth of the dividend, the expected growth of the dividend. Then all these we divide by the price, the market price. If we say the market price for Safaricom share, it is like, let's say, 20 shillings or 50 shillings. Then we divide by that. Then we earn plus the growth of that particular company. That one now will give you the formula. This is the formula in which we are going to calculate the cost of equity using the dividend growth model. We can look at an example. Let us look at an example. Look at an example here. An example. We are saying an example, you see that if a company has issued, equity shares, if a company has equity shares currently quoted at Kenya shillings 125 each, then say the company paid dividend of Kenya shillings 10 per share, and it expects a growth rate of equity, a growth rate of 5%, sorry, a growth rate of 5%. Then what will be growth rate of 5%? What is the costs of equity? What is the cost of equity? Now, this way we are saying that a company has issued an equity shares currently quoted as 125. Remember, 125 now, we are going to now to apply it into our formula. We have our formula here. We are saying that 125 each, meaning currently quoted. So meaning that our PO becomes our 125, sorry. PO is our 125 because it is the current market price. And the company paid a dividend of 10 per share. You're saying that the current dividend, which is DO, is 10 shillings and expects a growth rate of 5%. So our G here becomes 5%. So we can be able now to substitute that, whereby we say that our cost of equity is equals to, into brackets, that one, our DO is 10. We multiply by 1 plus growth rate, which is 5%, which is 0.05. That is 5%. Yeah, that is 5%. We can close that bracket. Then all these we divide by the PO, which is 125. Then all that we are going to add our growth rate, which is our growth rate expects to grow. Growth rate is 0.05. So in short, we are saying our costs of equity using the dividend growth model, it is 10 to brackets 1 plus 0.05. All these divided by 125 plus growth. Growth is, we have said it is 0. We have said it is 0.05. So here we can calculate, and we say that if you will be able to calculate that, you will be able to get the calculation now will become is what? This one is 10 divided by this one. If you use your calculator, you'll be able to come up with 0.134. This one now, and we say that the cost of equity, it is usually expressed. You express it in percentage. So we'll get it 0.134 times 100 to make it a percentage. So we'll have 13.4%. We'll have 13.4%. So that is what we are looking at. So the cost of equity for this particular company will be 13.4%. 13.4%. That is how we calculate the cost of equity using the dividend growth model. That is the dividend growth model. And in that, we can be able, sometimes you might be given now, you are not given the growth of a particular company. You can be given maybe the current shares, you can be given the current market price, you'll be given the market price per share, but then you are not given them the growth. How are you going to calculate for the growth? Now, let us look at how to calculate for the growth. How do we calculate for the growth? In calculation for the growth, we are saying that one, methods of calculating growth. Calculating growth rate. Number one, we are going to use what we call retention ratio. Retention ratio method. The retention ratio method. In the retention ratio method, we say that people or companies retain some funds, after trading in or after doing a very financial year, they have what they call in accounts, they call it retained earnings. The retained earnings. In accounting, we call it the retained earnings. The retained earnings. So in these retained earnings, we can be able now to approximate the growth at which our dividends will be able to grow. And how do we go about that? In this, using the retention ratio method, we are saying that the retention is from the retained earnings of a particular company. We say that the growth will be determined by B times R, where we are saying that our B here is profit retention. The profit retention ratio. Profit retention ratio, or profits. In the retention, we are talking about the profits that will not be distributed to the shareholders, the profits that will not be divided. Remember, you said that the shareholders, they expect some dividends. So the profits that will not be divided to the shareholders is what we are going now to approximate. And in every organization, they will say that every profit, maybe if it makes 10,000 or 10 million, it will say that 2% is going to be set aside as a retention. So that is what we are calling the retention, profit retention ratio, which is B. And then we are talking about R. R is return, is the return on equity. Is the return on equity. The return on equity. Oh, this one mean most companies, you say that the return on equity, they say that it is the return on, the return of investments. Return of investments. That people, they call it the ROI, the return on investments. That is how we are going to calculate. If in case you are not given the growth of a particular company, you can be able to determine your G if you are given now the retained earnings. So you get the retained earnings and you are given the return on equity, which is a certain percentage. Then you will be able to estimate the cost or the growth rate of a particular dividend. That is one. Number two, we're saying that how we are going to determine the cost of capital. Remember, we said we have two methods. One, we have said it is the dividend growth model. And then number two, we said we have the capital asset pricing, the capital asset pricing method. And in this capital asset pricing method, remember we have said that the cost of equity now, it is the risk of the shareholder. So that is this capital asset pricing model. We are saying that it is the relationship between the risk and the expected return. Because when a person checks about the amount of money to buy some shares, it means that he is risking it in expectation of a certain return that is going to come. That is what we are saying. The capital asset pricing model, we are talking about now the relationship between risk and return on investments. And return on investment. Return on investment. The risk and return on investment. So this model of determining the cost, we are saying we are dealing, basically exchanging or playing about now the risk and the return on investment. The risk that the person has incurred and the expectation that he expects to get when it comes now to the investments that this particular has made. And this one we have a formula. Remember we said our KE is the cost of equity. And the cost of equity we are saying we have or we call risk-free. We will be talking about this risk-free, and then we are saying beta, which is the relationship now, because we are saying we are looking at the relationship between risk and the return on the investment. And then we have now the return of the market, or the return of the market, then minus risk-free. And here you say, somebody will ask me, what is a risk-free? Remember I said that like when we have risky assets and non-risky assets. I'm sure in another topic we talk about risky assets and non-risky assets. We have risky assets and risk-free and risk-free assets. Like risk-free assets, we are talking about the government bonds. This is about risk-free. We are talking about government bonds. Because if you invest, if you buy government bonds or treasury bills in a government, that is risk-free. Because you are guaranteed you'll be able to get your returns. That is what we call risk-free. So, and in a person, he has to balance between the risk-free assets and the risky assets. So this is risk-free, this is a risky market. And now this one is the relationship. Because now the difference between the market, this one now, the return of the market and the return of the risk-free assets. So it means the difference now, there is a certain relationship which will give you now the cost of capital that you expect. That is what we are talking about, the relationship between risk and the return on the investment. Because you have to calculate your risk when you are investing, because you don't just go investing just when you are like a blind person. So we said our KE is equals to, KE is a cost of equity. We have our RF is a risk-free asset. Then we have, we can call it risk-free return. Let us call it risk-free return instead of the asset, so that there will be no confusion. And then we have our beta. Our beta, we are saying that it is the systematic risk. Risk of security. And then we have RM is the expected market return. Expected market return. So in beta we say that there is what we call the systematic risk and non-systematic risk, because our risks are divided into two. We have the systematic risk and unsystematic risk. In the systematic risk is where we say that the company can be able now to cushion the risk, or the investor can be able to cushion the risk. In the unsystematic risk is whereby we say that the investor or any person or a company cannot be able to determine the risk that is going to be involved in the market. So this one we determine our cost of equity depending on what we can be able now to adjust, or what we can be able now to deal with. And we say that the general idea between the capital asset pricing model is that the investors, they need to be compensated in two ways. One, because of time value of money and the risk. Remember, we say that time value of money is that your money requires to give you something. If you have your 1 shilling today, it should not be 1 shilling tomorrow or 1 shilling after 1 week. That is what we call the time value. And if it should not be able to be the 1 shilling after 1 week, then it means that there must be some risk involved in it, so that it cannot be your 1 shilling. So we are saying that the general idea between the capital asset pricing model is that the investor will need to be compensated either in terms of time value of money and the risk. And the time value of money will be represented by the risk-free return. That is what we call now the time value. We will represent the time value of money. And then when we are talking about the risk, now the risk now will be calculated now the amount of the amount of return that the investor is going to be compensated or will be needed, the amount of money that he will require extra, so that he can be able now to cushion the risk that will be there, which will be brought about by the systematic risk. That is how now we calculate now the cost of capital in two ways. We have said that we can calculate it in one way. We say that is the dividend growth model. And number two, the capital asset pricing model. That is how we are able now to calculate our cost of capital or the cost of equity. And when we say that in the calculation of the overall cost of capital, remember we said that we are not financing our business only through the shares or only through equity. We are financing it through debt. We are financing it through debentures. We are financing it through the bank loan and everything. So the cost of capital, we are saying that all the other forms of cost of capital will be identified by getting now the weighted average cost of capital. If we want to know, for example, if you have not used capital only, you have not used equity only, you have used a bank loan, you have used some debentures, you have used floating some bonds, and it means that you have now to consolidate all that and know that there is cost involved in that. So to get the overall cost of capital, you are going now to get what we call the weighted average cost of capital. Weighted average cost of capital. Remember, we are saying that we have the cost of equity. Cost of equity. We have cost of debt. Because all the other means now will be you are financing your business through debt or equity. So for you now to get the weighted average cost of capital, which we call it WACC, then we are saying that it is the average. Is the average. That is why we have called weighted average. We weigh, and in weighted means it is what percentage. When we talk about weighted, we are talking about on what percentage of either equity have you used, equity, or debt have you used. That is what we are calling of weighted. Maybe you have said that your business you are going to finance 40% with debt, and maybe 60% with equity. And in this equity, we say that either you can decide, this 60% you can decide to divide it. You will get 20% and 40%, 20% plus 40%, whereby the 20% can be through preference share, or 40% can be through a normal equity shares. Or preference share capital, equity share capital. So you can decide. When you talk about the weighted average, then you can get the weight. So we will have said your cost of capital, you can say cost of capital will be the weighted average cost of capital. So you can say you have 40% of debt, 40% of debt plus 20% of preference shares, plus 40% of equity or normal capital. So that is what we will call now will be your weighted average cost of capital. Whereby we are saying that in each category we are going to proportionately apportion now. And we say that the weighted average cost of capital is going to increase as what we call the beta or the risk of a particular company, how it is going to increase, or how the rate of return will be increasing. This one increases. And number two, weighted average cost of capital is going to decrease with valuation and higher risk. If you have a higher risk, then it means that your cost of capital or your weighted average cost of capital is going to be affected in that. So I hope now we are all together, we are following one-on-one, and we are through now with determining the cost of capital. Then we can move on specifically. We look at each individually. We can look at the cost of preference shares, we look at the cost of debt, and we also look at the redeemable and non-irredeemable. So here we can go ahead and say the costs of cost of preference shares. Preference shares. Remember we said that the preference shares they are the kind of shareholders who are going to be privileged, who are going to be privileged to get dividends before the ordinary share capital. So these ones now, they are like special shareholders in a particular company. And in here we say that the formula for calculating now the cost of preference share capital, we are saying that is the dividend divided by the price, or the market price. Where we are saying that KP is the cost of preference shares. Preference, can do shares in short form. We are saying that D is the dividend preference. Dividend of preference. And PO, we see that is a market price. And remember, when it comes to the preference shares, we have now the cost of floating these preference shares, because we are saying that they are like specialized shareholders in a particular company. So when we are talking about the market price of the company, remember this market price of the company, when we are calculating the cost of preference shares, it has to be minus. It has to be minus what we are calling the floating cost, because the preference share capital, they are going floating cost. The preference share capital, they are more expensive than the ordinary share capital. So there must be some floating cost. When you are talking about the market price, then we have to deduct the floating cost of that particular company. Then from there we remember I talked about the redeemable and the irredeemable preference shares. And when I believe that one we learned in business studies, whereby we have the different types of shares. We have what we call redeemable. We get redeemable preference shares. Preference shares. Of the redeemable preference shares. And the formula for calculating the redeemable preference shares, the cost of calculating the redeemable preference shares, we see that is the cost of redeemable shares. We can denote it as KD so that we may not confuse with the KP, which we see is the preference shares. The cost of redeemable shares is going to be, we have 1 plus to the brackets, where we say that RV, it is the redeemable value, then minus, or we call the sales value. You close the bracket, so redeemable value minus the sales value, you close the bracket. All this, which is now the redeemable value minus the selling value, you divide by what we call our N. Our N we will be talking, we will know is the N will be the number of years. That one will be the number of period. What is called is the period. Then we have, you close the bracket, so that one you close the bracket. Then we have 1 minus T. All these you divide by what we call the redeemable value minus sales value. No, it is plus, sorry. Divide by 2. That is the average. You get the average. That is the average, the redeemable. And so here we are saying that RV, we can start with the KD, is the cost of preference share. RV, we have seen it is a redeemable value. Remember, they are going to be given the value in which the shares can be redeemed at. Because if you want now to redeem your shares, this one is the redeemable value. Redeemable value. Then we have the SV. We are saying it is a sales value. We are saying C is the sales value, or what we call it. We can call also this one, we can call it the issue price or the market price. The market price. That way you'll be able to get T is the time. You remember when you calculated the cost of when you are calculating the cost of the risk. Remember when we are equating now the risk and the time. Remember we have the number of periods and the time that we are talking about. So that one, redeemable value, we have denoted the preference shares and everything. D is the preference shares. So that is how we are going to calculate the redeemable, the costs. This is when we say that cost of redeemable preference shares. Cost of redeemable preference shares. And we remember you talked about the weighted average cost of capital, and the weighted average cost of capital. Remember, and I've not given that. We talked about the weighted average cost of capital. Never gave the formula, and the formula is a formula here. We are saying that cost of equity times equity plus cost of debt times debt plus cost of preference shares times the preference shares. Now these times are all these you divide by equity plus dividends plus preference plus our R, which is the book value of the retained earnings. Remember R, we talked about the retained earnings. So here we can denote and say that KE, we are saying that, we're saying that is the cost of equity. KE. We talked about KD. KD is cost of debt. KP is cost of preference shares. Preference shares. Then we have what else do we have? What else do we have? Oh, there's something else of okay. Yeah, this one is plus cost of retained earnings times retained earnings. Sorry, I missed cost of retained earnings. Then we have KR is the cost of retained earnings. Cost of retained earnings. Then here we have E is book value. Book value of equity of the firm. D is the book value of debt of the firm. Then we have what? P. We have the book value of preference shares. Preference shares. And then we have R is book value of retained earnings. So when we have now the weighted average cost of capital, it is your way of financing of a business. Meaning that if you use equity, if you use preference shares, if you use your retained earnings, or if you use your preference or your debt, then it means that you can decide which way now to use it. It depends now on the finance manager or the owner of the company, how he wants now to finance his operation. He can either float the shares, sell the shares, he can get a bank loan, which is the debt, or he can get the preference shares, he can do it the preference shares. He can decide to use the retained earnings or plow back the profit that he has saved from the previous years. And then from there now, he can be able now to get weighted average cost of capital now will give you a combination of what this particular person has been able to use to finance his is business. And we say that when we use this weighted average cost of capital, in short, we use that, we use it to determine, it is used to determine what we call the net present value of the company. This one will give you, if you are able now to know your combination now of the debts or how you have financed your operation, then we are able to determine your net present value of the cash flows using now your weighted average cost of capital. And I think when we are there, we can continue and move. We look at the cost of retained earnings, and then we look at the cost of debt, and then we'll be able now to call it a day. So that. Let us look at the cost of retained earnings. Cost of retained earnings. The cost of retained earnings. The cost of retained earnings, we say that cost of retained earnings. Cost of retained earnings will be equal to the cost of equity. Somebody will ask me how the cost of retained earnings will be the cost of equity. Because you remember that when we say that the retained profits are the retained earnings are the profits that have not been divided, given as dividend to the shareholders. So these retained earnings, they still belong to equity shareholders. Remember, it is some money that was there, but we have not given it out to the shareholders as dividends. So it means that it still remains their own money. Because remember, the shareholders, they are owners of the company. So if they are the owners of the company, then whatever is in there, whatever has been retained, it is still their money. That's why we are saying the cost of retained earnings will be equal to the cost of equity. Now let us look at the cost of debt. Costs of debt. And the cost of debt now here will be, the cost of debt, we'll say that we have what we call redeemable debt and irredeemable debt. And here now we say that, let us start with what we call irredeemable. Irredeemable debt. And in the irredeemable debt, we say that the cost of debt, we are saying that it is 1 minus time divided by, this you divide by the market price. You divide by the market price, where we are saying that this KD is the cost of debt. Cost of debt. T, remember, when you are getting a debt, then these debts, we say that in accounts, debts are taxable. And if debts are taxable, then there must be some taxation. So this one will be tax rate. This one will be the tax rate. That one will be the tax rate. And then now this one is the issue, SV. We call it the market price. The market price. For example, let us look at an example. Let us use cost of debt. And we rub this. And here we are saying that the cost of debt is 1 into 1 minus tax rate, all this divided by the market value. Saying, let us look at an example.